Hey traders, Raghee here, and in this recap video I'm going to make it short and sweet. It is a Friday afternoon and I think right about midday. My brain just said uncle. It's been a great week. We've had a couple trades that have decided that they don't want to keep working for us anymore, and it's always good to get rid of those, but I want to talk a little bit about those trades that we should never be in the first place. Now, it's been a while and I always get asked about metals, and one of the things that we've been talking about with metals, and I'm going to circle back to silver here in a minute, and I really think it's going to be something that you guys will get a lot of benefit from. Just like yesterday I gave you guys my recipe for how to deal with choppy markets, today I'm going to give you my recipe on how not to get steamrolled by markets. Now, we know there are certain events like non-farm payroll and FOMC and ECB and crop reports and crude oil inventories that can trigger major economic volatility by way of triggering price action to push this upper price movement ranges, right? Economic triggered volatility. Crop reports are not surprises. We know about them well in advance. If I decide to take a soybean trade into crop report, I do know what the risk is, and I do know when the risk comes in. If I decide to take a dollar index trade into non-farm payroll or a Dow trade into non-farm payroll, again, I know what time, I know what the risk is. But it's those events that don't have a heads up. It's those events that don't have any kind of event or trigger attached that can almost be the scarier ones. And silver was such an example. Now, it's easy for me to say, okay, this is a flash crash. And when people say traders were freaked out, I want to reiterate. And I know for those of you that are in this or wow, I don't want this to be one of those, you shouldn't have done this kind of videos, but let me show you what you're supposed to notice so this doesn't happen again, okay? I really want to help you guys with not getting steamrolled. So there's a flash crash. The only people that were upset about this flash crash, gang, were long traders. They say traders were freaked out. No, gang, buyers were freaked out. That's what the situation was there. So take a look at what's been happening with silver. And I don't mean the chop we've seen throughout the year, but I mean right now. If you take a look at when silver re-engaged the bearishness and arguably reconfirmed the downtrend, and again, I don't mean to be salt in a wound for traders that might be long silver as they're watching this video, but I sincerely have to ask you a very simple question, and it's because I care. Why? Why would anybody be long silver when the dominant psychology has organized into a downtrend and we're exhausting in the wave and plotting red grab candles? This is what I visually want you to notice. Sure, the flash crash just happened. That's this right here. But notice we've had 1, 2, 3, before this, 3 pretty sizable down candles already. Bottom picking has a cost when you're stepping out in front of the freight train like this. The only trade that made sense was to be short. Now, if you're trading intraday, the danger in taking these trades intraday, the danger in taking these trades overnight or when they're unmonitored is because these do trade on a 24-hour basis anymore. They kind of trade like Forex markets. And the danger in that is you don't know when something's going to get triggered. It could trigger at an odd time. What time did this flash crash occur? Let me show you right here. This wick happened at 7:10 yesterday evening. 7:10. And a broker buddy of mine said, oh my gosh, trades were getting busted. It was a disaster for buyers. Sellers woke up and said, happy birthday to me, right? So the thing here is, even when I'm intraday trading, I want to be aware of what the end of day charts are showing. All right? So does that mean I can't go long on a 5-minute chart if I have a downtrend? Of course I can, but I want to be cognizant of the fact that the trend is heading lower while I might be taking a small window of opportunity on a short-term time frame with the market trying to head higher. I want to be nimble about it. I don't want to commit longer term to a counter trend trade. All right, let's use gold as an example that's not so dramatic, but still the same story, which is look at the red grab candles here. Look at the bearishness that preceded the weakness we see in gold. Is there any reason to be committing to a long position in gold? Very little. But let me talk to you about something that you can do, because sometimes we all want to satisfy what I call the pig in the head. That little voice that says, and I get it too, gang, I've been at this for 30 years and I still get it, who says, well, what if? What if this is a bounce? And it did bounce a little bit, and then we just broke it and made a brand new low, right? The way you satisfy the pig in the head, the what if trade, and gosh, those what if trades can hurt if you commit to them too aggressively, is you buy some calls, right? You have a little bargain with the pig in the head and say, you know what, I think that's a bad idea. And gosh, the more you tell the pig in the head it's a bad idea, the more that little voice wants you to take the trade. Go, you know what, I'm going to take some options here. I'm going to grab some options and get long GLD. I'll give you a couple of weeks to let this trade play out, and I'll grab some options in GLD. You've quantified your downside, and who knows, you might actually be able to take the trade and be right. Case in point, my little pig in the head said, hey, let's see if we can find a floor on the 30-year. And I thought, well, there's some justification. I've got a low, I've got a handle, and I've got non-farm payroll. Things could line up pretty well. And then we get a global bond route, right? But the same voice said, well, let's do the same thing on the triple Qs, and that worked out fantastic, right? So actually it was a NASDAQ entry that I used the Qs for. And today that worked out fantastic. So there are ways you can manage this, but the first job we have is to identify the underlying market trend. So this really is an extension of yesterday's conversation, yesterday's recap. And if you didn't watch it, watch that video and then watch this again, because it really is a similar conversation. Your analysis and your strategy must start with the underlying market trend. And I'm going to say the same thing here. Why would anybody be long silver? It makes no sense. I'll say the same thing. Why would anybody be long gold? But if you have that temptation to bottom pick, if you think there's a floor in place, go with SLV options. You absolutely quantify your risk, and if there is a volatile move to the upside, you've got some skin in the game without destroying your account. And sadly, there were a lot of busted trades here, gang. This had to have been an ugly move, even in the aftermath of it, with this market moving down to 1550. You know, and that kills me, and I want to prevent that. I want to make sure you're not on this side of the wick. Okay? All right, gang, that's tonight's recap video. Hope it's of help to you. I'll see you in the next update.